Okay, next topic is earnings per share. We call it EPS. The concept here is that you calculate the earnings of a business, whatever earnings are. I'll explain you what do we mean by earnings, divided by the number of shares. Okay. This is one ratio, which is, it is actually, if you talk about financial reporting, this is standard. This is IS 33, earning per share standard. It's one of the very important standards, especially for public limited companies, which are, I mean, where the stocks are bought and sold on a stock exchange. And investors are always looking for EPS, earning per share. Um, let's suppose your earnings are, let's call it 1 million. And your number of shares are 500,000. So you will say that earnings are $2 per share. Okay. The first thing is that, what do we mean by earnings? Earnings mean that those earnings, those profits which are attributable or which are available to be distributed to the ordinary shareholders, which means that you have already paid all of your expenses. You have paid your interest, you have paid your preference dividend as well. You have paid preference dividend, you have paid interest, you have paid all of the expenses. Whatever is left, that is called earnings available to ordinary shareholders. And you divide it with the number of shares. If we go into more detail, more accuracy, we would say weighted average number of shares. How do we calculate it? It is not needed for the purpose here. Okay. So you can just remember in simple that it is number of shares. This is one ratio which investors are always looking at. And in the financial management, for the purpose of financial management, we never take any decisions in financial management which will negatively impact your EPS. Okay. So anytime you are borrowing money from a bank, or you are making a new investment project, you are taking some debt, you are issuing some equity, whatever financial decisions you are taking, you always pay attention to that my EPS should not decrease. My EPS should not go down. Earnings per share. This is like the part of the profit which is like available to each share. For example, when I said $2 per share, which means every share has earned $2. Every share has earned $2 over 1 year, because we calculate it for year. So we say that earnings per share is widely used as a measure of a company's performance. Yeah, it is one of the few ratios. It is one of the few, things which are considered while seeing the performance of a business. A company must be able to sustain its earnings in order to pay the dividends and reinvest in the business so as to achieve future growth. Yes, because when you make earnings, you have to pay a part of those earnings as dividends. So if we make $2 earnings, like we said that, you said that you made $2 per share. This is your EPS, but it is not necessary that the business will distribute $2 every share. It will not happen. Dividend might be less, and I mean, actually, it should be less. Dividend would be 20% or 30% of the earnings. So if you see an EPS of $2, you can expect maybe 40 cents or 50 cents dividend for each share. And of course, you should have sufficient earning. The more earnings you have, the more dividend we can give, and then we will also have surplus, surplus profit or retained earnings to invest in the future projects and so on. So the higher the earnings, better it is. And by the way, investors also see this thing as a ratio as well. In the terms, for example, if you say that you made $2 earning, so what was the price of the share? The price of the share was $20. So you say, okay, earnings are 10% of the share value. This is also one way of seeing it. Investors also look for growth in the EPS from 1 year to the next. Yes, if you had a $2 EPS last year, it does not mean that you should keep it $2 always, because in the next year, investors might be looking at $2.2 or $2.5. Why do they want to have increase in the earnings? Because the share price is also increasing. Because in the year 2022, your EPS was 2 and your share price was 10. Share price was 10. So you said, okay, 10, I'm sorry, 20. So you said that we made something like 10% of EPS over the price of the share. In the year 2023, the share price has already gone up to 25. So it means that the investment in one share is 25. So if you are still getting $2 of EPS, it means that now your percentage might be like 8% or 7%. So when as the share prices are increasing, we expect that EPS should also increase. And that makes very much sense. Earnings per share is equal to net profit or loss attributable to the ordinary shareholders, after tax divided by the weighted average number of shares. So like I said in the very beginning, that when we say earnings, it does not mean PBIT, profit before interest and tax. It actually means net profit after interest, after tax, and after paying preference dividend. So we have already settled all the liabilities, and now whatever is available, this is what we can give to the ordinary shareholders. So we say earnings attributable to the ordinary shareholding divided by the weighted average number of ordinary shares. Why do we have weighted average? It's another topic, because in the beginning of the year, you might have 1 million shares. Then during the year, you issue 500,000 more shares. So end of the year, you have 1.5 million shares. But these 1.5 million shares do not remain with you throughout the year, because beginning of the year, you had 1 million. Then somewhere in October, you issued half a million further. So you cannot say that my shares at the end of the year is 1.5. So you cannot divide it with 1.5. You have to consider weighted average. Like 1 million shares, they remain for a period of 12 months. So I would say that 1 million share remain for a period of 12 months. And then this period is a different. You can do a calculation like this as well, like 1 million. Total number of shares are 1.5, okay? So 1 divided by 1.5, or you can say that 1 million divided by 12 months into 9 months, because until 30th September, you had 1 million. From October, November, December, you issued 500,000 more. And then what do you have? You have 1.5 million again, but this is divided by 12 into 3. So it shows you that for the 9 months, you have 1 million. For 3 months, you have 1.5 million. And then when you make a total, you will get weighted average number of shares, okay? This is also a very simple calculation. In reality, these calculations can become more complex when you talk about diluted EPS and so on. But diluted EPS or potential ordinary shares which are convertible bond, which would be converted to shares, this is not within the scope. So we keep it very simple, weighted average number of shares. Okay, so let's do one question, very simple example. It says that a company has pre-tax profits of 12 million, tax rate is 30%. They have 1 million, 8% preference shares and 20 million ordinary shares. So you've got two types of shares, preference shares and ordinary shares. Preference shares are at 8%. So your preference dividend will be 1 million into 8%. You know that this is a fixed dividend. So 80,000 is your preference dividend. This is fixed preference share. And you've got 20 million ordinary shares for which you do not have any fixed dividend. So what are the earnings per share, or what is your EPS? So 12 million, I have my profit, and this profit is before tax. So I have to subtract my tax expense. Then I have to subtract my preference dividend. Then whatever is left, that will be called your earnings available to ordinary shareholders. Let's see. Okay, options are 39.6, 41.6, 42, and 60 cents. So these are the 4 options which are available, A, B, C, D. Let me show you the calculation, how you should do it. You should do it like pre-tax profit. Okay, this is the same thing repeated here so that the numbers remain in front of you. So first of all, you say, okay, how much a profit? 12 million. First, you subtract the tax. Let's put it in bracket. So 3.6 million is the tax, 30%, that's gone. What is remaining is profit after tax, 8.4 million. You must subtract preference dividend from here. Okay, because earnings to ordinary shareholders, you have to subtract preference dividend. So you subtract preference dividend, and this is called available for ordinary shareholders. So these are the earnings available for ordinary shareholder. This we have to divide with the number of shares. Which number of shares? Ordinary shares, 20 million. Because preference dividend I have already subtracted, so preference shares I will not calculate. So to get your answer, you have to do 8.3 million divided by 20 million, just the ordinary shares, okay? Preference shares you don't include. And whatever it gives you, that should be the answer, 8320 divided by 20,000. So this is 8320 000 divided by 20 million. 0.416. Answer is 0.416, which means 41.6 cents. This is in dollars. If you convert it in cents, because in this question, they gave you answers in cents. So when I say $0.416, that actually means 41.6 cents. So this will be your answer, okay? They are giving you other options as well, which are of course wrong, but why they are wrong, let's see it. So let's calculate here. Answer should be 8320 divided by 20 million, 41.6 cents or $0.416. It's the same thing. Incorrect answers. A, C, and D were wrong. What were the mistakes in A, C, and D? Now, if you pay attention to what mistakes did they make? So 12 million into 0.7, this is correct. 0.7 means that 30% tax you take out, whatever is remaining is 70%. And then you subtracted the preference dividend. This is also correct. But you divided with 21 million, which means that you included ordinary share plus preference share. This is wrong. You don't divide it with 21. You have to divide with 20 million. So this option is wrong. The second option, what they did 12 million into 0.7. This is correct. But they did not subtract preference dividend. They divided with 20 million. This is okay. But they did not subtract preference dividend, which they should have. So this answer is also wrong. And in the last option, they were very simple. They just took the earnings 12 million and divided with 20 million, ignored the taxation effect, ignored the preference dividend. So of course, this is also wrong. So you need to understand how to calculate the correct EPS with the given numbers. So this is how you calculate your EPS. One little thing is, like I said, I was saying it before, that if you have an earning of $2 per share, it does not mean that you are actually going to give $2 to the shareholders. Because number one, you will not have cash available in $2, because some of the money you already have invested in inventories, and some of the money you already have invested in non-current assets. Maybe you have receivables and so on. So this is $2. But you don't have, number one, you don't have cash $2 per share to give. Let's suppose you have 1 million shares, okay? So if you have 1 million shares and you've got 2 million EPS, so it means that your profit attributable to shareholder was 2 million, okay? That's how you calculated this thing, because 2 million divided by 1 million shares got $2 per share. So your profit was 2 million, but your cash will not be available 2 million. Cash probably available is 1 million, maybe 1.2 million, maybe 900,000. So one thing you remember, that whenever you see EPS, it is the earnings which have been earned, but we are not going to distribute it. This is earnings which the shares have earned, but we are not going to give it. Generally, companies, they give out dividends like 25% of this earning, maybe 30% maximum. So if you see that you have got $2 per share as earnings, so what you decide, the board will decide that we are going to give 25% dividend from EPS, which means we are going to give $0.5 per share. This is the dividend we will distribute to the shareholders in form of cash, and remaining $1.5 is called retained earning. this will be kept in the business and for the future investment. We want to grow, we want to buy some new equipment. So your EPS ultimately will be divided into two parts: the dividend, which we have already given, and the retained earnings, which we have kept in the business. We call it profit retained, we call it retained earnings, we call it, retention. So dividend per share, shareholders always look closely at this because they look forward to receiving the dividend. Yes, they are looking at, okay, you made $2 EPS. How much dividend are you going to give? However, as a long-term measure, dividend per share is flawed as it depends on the discretion of the directors. So what does that mean? Like we said, that when you want to analyze the performance of a business, EPS is a good measure. Okay, it's a good measure. It says that dividend is also a good measure. Here it says that shareholders, they also look closely to this, that how much dividend a company is giving, 50 cents, $1, $2, $3. And if you receive or if you get more dividend, you might be happy. Oh, this company is giving a lot of dividends. But it says that it is flawed, which means that it is not something which is very good for analyzing or for analysis purposes, because it depends on the discretion of the management. It is possible that management does not give any dividend. They made a lot of EPS, but they are not giving dividend because they have some new projects coming in. So you say, oh, the dividend was zero, so this company is not doing good. No, the company is doing good. The only thing is that they are not giving you dividend, but the business is doing good. This is one way of seeing it. Another way of seeing it, that probably your profits are zero, but the company is giving a lot of dividends. Where? From the past earning. If you remember from last year, we kept $1.5, $1.5. So this year we don't make any profit, but still we are giving dividend. So if you see, oh, a lot of dividend, but that does not mean a lot of profits. So what it means that although dividends per share we do look at, but this is not something on which we can blindly trust or which we can blindly rely on. And directors will often try to maintain dividend payments even if earnings fall, as this might prevent shareholders. Yeah, I mean, right, directors, they try to keep a steady dividend policy. So that's why they are keeping $1.5 from last year, so that in next year, if profits are not more, still we will be able to give 0.5 or 0.6 because we have kept some profits from the past. Profit retention, of course, whatever dividends you have given, that is gone. Whatever you keep within the business, that is called retained earnings, or that is called profit retentions. A profit retention, a target for profit retentions can be set. So companies, they set the target, okay, 75% we will retain, which means 25% we will distribute, or 70% we will retain, which means 30% we will distribute. For example, management might set a target that dividend cover, the ratio of distributable profits to dividends actually distributed, should not be less than, say, 4 times. 4 times means 25%, okay? So either you call it 4 times or you call it, like I said, that $2 was EPS, 0.5 was the dividend. When you divide this thing, you get answer 4. You get answer 4. Okay, so you can call it 25% of EPS, or you can say that earnings and the dividends, their ratio should be 4 times. So this is a very short topic of EPS. Now we move to the next session.